promissory note documents. I know we keep on repeating promissory note, mortgage, and all that stuff, but now we're going to look at what the document actually is, what it entails. So the borrower executes a promissory note, is the maker or payer of the note. The lender is the payee. See how there's a pattern here? Maker, payer, payee, right? To be properly executed, all parties who have an interest in the property should sign the note. And the note sets forth the loan amount. So this document sets the loan amount, the term of the loan, the method and time of repayment, the interest rate to be paid, and the borrower's promise to pay. All right. So this is the promissory note. The mortgage document is different. Right? Remember, you got two documents, promissory note and mortgage, or we also have deed of trust, depending on the state that we're in, right? The note might also state that it's payable to the bearer if used with a deed of trust, or to the mortgagee if used with a mortgage. Other items in the mortgage document or deed of trust may be repeated in the promissory note. For instance, the right to repay the loan balance, the charges for late payment, conditions for default, notifications and cures for default, and other charges. Okay. Promissory note is a negotiable instrument. All right. And here's what I want you guys to think about when you see negotiable instrument. You guys know what a check is, right? Listen, I barely use a check nowadays, so just wondered. But if you know what a check is an IOU, right? I said before, right? You saying to whoever the receiver is. Elvis is saying why? Oh, you still use checks? Oh, I also use it as well, but very rarely. Like most of the stuff I have on auto pay, and you don't go to the supermarket anymore with a check. So, you know, does anybody remember going to the supermarket and paying with a check? Right?
I used to work at a bakery and had a regular like and for $10
You used to work at a bakery, and one of the regular customers would always pay with a check,
and it was never
like $10. Wow.
It's so stupid.
Anyway, all right, crazy. So for those of you that are saying no, yes. So back in Portugal, for instance, we would run up a tally for the week and then pay with a check. So that doesn't happen anymore in Portugal either. Like nobody trusts you anymore, because that's what a check is. It's a trust basis. I owe you. I promise that there's money in the bank, right? What is a promissory note? It's a trust basis. I'm giving you a loan, and I'll trust that you pay back, right? Trust base. So, but what I was trying to say with a check is, if you guys receive a paycheck and not direct deposit, another reason why we don't see many checks nowadays. If you receive a paycheck, or if you receive any check, what do you do with it? You have to deposit it, right? See, but here's the thing. The check, right, says here to, let's say, Bruno. The check is written out to me, right? It's not written out to the bank. So I have to go to TD Bank and deposit the check. What they'll do is in the back of the check, they'll put a stamp, and this stamp says, pay to the order. Oops. Sorry. The order of TD Bank. So pretty much what we did here is an assignment. You guys remember the word assignment? Okay, so we take that check, we give it to the bank now puts a stamp on it that says, you transferred it to us. And by endorsing it, when we sign right here, by endorsing it, there you go, Shanice, yeah, by endorsing it, we are allowing that assignment, okay? So technically, my employer paid the bank. That's what just happened. Does that make sense, guys? All right, it's a negotiable instrument, it's a tradable instrument. Now, it could be under my name, but I can cash the check, which I must. So I have to negotiate with whoever is cashing the check. Now, If you don't have a bank account, where can you go? To a check cashing place. Yeah, you go to a check cashing place. And a check cashing place will charge you a fee. So again, we're negotiating again, right? What promissory notes do is the same thing. A lender is supposed to receive payments from you. So think of you as you wrote the check to the bank. The bank, to cash that check, right? They can cash it and receive, just collect those payments, or they can endorse it to another bank. It's called an assignment between the banks. They transfer to another bank, a third party. So sometimes we close, that's what this means, being a negotiable instrument. Sometimes we close with Bank of America, and then could be the same day, could be a week later, could be a year later, 10 years later, we're now paying Chase Bank. And you're like, wait a minute, why am I paying Chase Bank? I closed with Bank of America. Because they assigned, they negotiated a term and agreement for the collection of that money. Does that make sense? So what just happened was this. You wrote a check to B of A, right? And then what Bank of America did was assign that check, or the IOU, because that's what this is, an IOU, promissory note. They signed that check to Chase or whoever they're transferring to. Good? You guys good with this? Tomorrow we're going to learn about secondary markets, and that's what this happens. This transfer happens in the secondary market. So I originated the loan with Bank of America, but then Bank of America sells it in the secondary market to Chase. Okay? All right. So the assignee, whoever receives, so in this case, Chase, in my example, would then have the right to receive the borrower's periodic payments. All right, the next thing we have is mortgage document and trust deed. Mortgage document and trust deeds document. So in the mortgage document, the borrower who executes the mortgage is the mortgagor. And the lender is the mortgagee. Very good. If it's a trust deed, the borrower is the trustor and the lender is the, aha, now I tricked you. The lender is not the trustee, the lender is the beneficiary. Okay, so the mortgage or trust document identifies the property being given as a security and given both its legal description and mailing address. The document contains much of the same information as the note, including the debt amount, the term of the loan, and method of and timing of payment. So this goes on the mortgage. But what really is important on the mortgage is the identification of what's being given as a security. What is being given as a security in the mortgage? The property. It's not the house. The house? Really? We're giving the house? What are we giving as security, guys? I'll say a lot.
The property.
What is the property? What entails the property? Because if it's just a house, then I'm going to detach the house and let the bank take the house. So it's the land and whatever's on it and all the rights, right? So the house, plot of land, and certain rights. In this case, the interest or future interest of collecting the property if unpaid. That's why we include a legal description to identify the property. Now, you know what the question is going to be right after this one, right? What is the question?
Is a legal description.
What is a legal description? Okay, so what is a legal description? That was not the question, but what is a legal description? No, those are the types of legal description. Since you asked what is a legal description, I want to know what is a legal description. I was going to ask what types, but since Masha decided to,
Oh, I just worded it wrong.
that's what happens when you don't pay attention to the question.
Legal description.
Guys, cameras, sit up, please. I need to see you and be on camera. What is a legal description?
Description of the house using any of the
Of the
types
house again?
of the property. Using any of the types of legal description, which you're gonna ask about is.
So Milton Road surveyor. You're close to it. Randy, that's a type of legal description. What I'm asking is, what is a legal description? Okay, did you Google it or you go back to the page? Shakira goes, it's an exact geographic description of the specific parcel. There you go. And Jefferson, no, it's not the address. The address just tells us what the destination is. The address is something we put on the GPS. It doesn't tell us what we're looking for. It tells us where the destination is. Okay. That's why legal description and mailing address, see right here, legal description and mailing address are two different things. Okay. So legal description, it's an exact geographic description of a specific parcel. It's what tells us this is the piece of land that we purchased. An address says this is where it's located. Okay, so two separate things. Now, what types of legal descriptions do we have? Randy already started with meets and bounds. The rectangular one or government survey system and blocks and lots. Thank you. Thank you very much. All right, so it's very important you guys know this stuff, and that's why I keep on going back to it, because there might be questions on the exam. Right? If I keep on going back to something. All right. Now, another thing that's described in the mortgage document, not promissory note, but in the mortgage document, right, is the duties of the borrower, obligations of the borrower. So the borrower, whether a mortgage or a trustor, is required to fulfill certain obligations created by the mortgage or deed of trust. These usually include the following. Now, the first couple of ones, it's common sense. You guys know this. The first one is payment of the debt, right? So if I borrowed money, what must I do? Pay it back. All right. So that's the first obligation. Everybody knows it. It's easy. Number two, if it's real property, then he has real property taxes. So I got to pay what? Taxes. That's also easy. Number three, maintenance of adequate insurance to protect the lender in the event of the property being destroyed or damaged by fire, windstorm, or other hazards. So I got to pay the debt, I got to pay the taxes, I got to have insurance. You guys already know this. These are basic requirements, right? Yes? Okay. So the last two. I bet 90% of you guys did not know this. The last two. Maintenance of the property in good repairs at all times. Did you know the lenders requires you to maintain your property? And if you don't, right, meet any of these obligations, you'll be in default. You have to maintain your property, good repairs at all times. All right? How would they know?
Do they come around and check that?
They could inspect if they wanted to. Most of the times they don't.
Yeah.
They wait until there's some type of claim or a complaint violation from the city or something like that. That's what they wait for. Insurance claims, right? And what about this one, this last one? You need to have lender authorization before what? Making any major alterations. Before making any major alterations on the property. So you want to finish a basement? That's a major alteration. You want to add a level? That's a major alteration. You want to put a pool there? That's a major alteration. So any major alteration, like if you're going to paint, you don't need permission. If you're going to, just replace a wall because it needs to be fixed, something, that's not a major alteration. It's okay. But if you're going to do an expansion of the house, right? Sideways, up, whatever, or a basement, finish a basement, those are considered major alterations. So you got to have the lender's authorization. This is what's on the mortgage. requirements. Okay, that nobody reads, but it's there.
You call bank, can I finish my basement? Okay, so yes.
So it's not about can I finish my basement? It's about notifying them pretty much. This authorization is like, hey, we acknowledge that this is what you're doing. What they want to know, guys, because you have to understand, all of these are related to one thing: protecting an investment. No, people don't do it, Connie. Nope. Milton, yes, that's separate from this. Taxes might increase, yes, but that's separate from this. What you need to understand is that I'm the lender. I just gave you $500,000 for you to buy your house. Okay. I want to make sure that you do everything possible to protect my investment, right? You're going to make the payments because that's what I gave you. You're going to have taxes paid, so nobody has a superior title to mine, right? Or rights to the property than mine, right? You're going to have property insurance because if there's a fire, I want to make sure that the property is rebuilt, insured, so it's rebuilt, so the damage, it recovers from the damage, right? Maintaining good repairs at all times for what? To maintain the value of the property, because it's my investment. If it's destroyed, if you look at it, it's destroyed and not fixable by insurance because it's just poor maintenance, what happens to the value of the property? It drops. I give you $500,000, it's now worth 400. I'm losing money, right? And finally, major repairs. I just want to make sure that you applied for all the permits, that you're doing everything properly. Because if you're not, and you finish a basement without the permits, right? Then you don't have a CO, certificate of occupancy. Something goes wrong, the insurance company will not pay for it. If there's a flood in that basement that you just finished without a CO, the insurance company says, oh, my policy says, right, that the homeowner is supposed to do things properly. If they didn't, then we're not responsible for it. They in fact committed either fraud or negligence in handling the property. So that's pretty much what it is. All these duties here are to protect the lender in the event of any of the defaults. Yes.
If a homeowner already finished the basement and he did not notify the lender, if he goes now and notifies the lender, will they come and check it out? Like,
So, great question. Common question, which is, what if I already did it and never told the bank? All right, so again, like I said, replied to Connie, most people don't do it. They don't even read the mortgage documents. They just sign, they know how they have to pay, and that's it. Most people don't do it. The problem is, if something happens, then they're like, oh, I didn't know I had to. And the bank is going to be like, at the closing, you signed 1,000 pages, and one of those pages says, this is what you're supposed to do. You didn't read it. You signed stuff without reading it. Oh my God, right? So it's like getting into that gym membership and you don't know that you cannot break out of it unless you're dead. So anyway, so can you notify them now? That's your question. Yeah, of course you can. But my question is, did you do everything with permits? So before you notify them, make sure you're looking for permits, because they're gonna ask for it.
what permits would you need? Like from whom?
From the city.
Should it tell the city? when-
Oh, yeah. And then what Milton wrote, taxes will increase, possibly. That's why people don't get the permits. Like, I don't want to pay more taxes. Yeah. Okay, if you don't notify the lender, but you did get the permits, is that a problem? No. Because all they want to know, guys, all they want to know is that you're doing things properly. So getting your permits, that's key. All right, guys, before the break, I asked one thing, your full attention, right? And to be on camera. That's one of the things I asked, so I don't have to keep on repeating this. So please get back on camera or I will kick you out. Those of you that are doing this for the first time, of course. If you're repeating, it's okay to be off camera. But if you're not, if it's the first time, I will have to kick you out. All right, so that's pretty much what it is. Now, if a borrower, Connie, didn't do things right, doesn't have permits, doesn't have anything, right? If the borrower does not meet any of these obligations, notice how it says any. most of the times, what I'm gonna say is because you didn't pay the mortgage, right? But if you don't meet any of these 6 obligations, they may be in default. And loan documents may, however, give the borrower the grace period, for example, 30 days, during which they can meet their obligations and fix the problem. If the borrower doesn't do this, the lender can take any of the steps listed below. So if you don't fix the problem within whatever specified period of time, the lender can, 1, exercise what's called an acceleration clause. What is an acceleration clause? Helps the lender take back the property if the borrower doesn't pay back the loan, for instance. This means that the lender can demand the full amount of the principal balance immediately. Without an acceleration clause, every time a payment was late, the lender would have to sue the borrower. So here's what happens. You defaulted. They give you 30 days. They give you a notification, say, hey, Connie, right? In case you don't remember, you missed last month's payment, right? And then by law, this is FDCPA, Federal Debt Collection Practices Act. By law, they have to give you another notice. So now, 60 days later, they go like, hey, Connie, so you kind of forgot the previous payment and this month's payment too. So just letting you know, if you don't cure the default in the next 30 days, we're going to go to court. And that's what happens. By the 90th day, so 60 to 90 days is the period usually. By the 90th day, they go like, hey, Connie, we give you all the warnings. All we were collecting on was 2 payments. Now, we want the full amount of the loan immediately. And that's what we sue you for. We want the whole $240,000 balance on the loan. That's what we're looking for. Okay, this is called acceleration clause. Acceleration clause means you had 30 years to pay, but since you defaulted on some payments, we want everything now because we don't trust you anymore. Does that make sense? Like, I'd rather collect everything now than wait and see what's going to happen. And some, well, and that's the thing. Some of you are like, oh, if you can't pay it. Well, that's what foreclosure is for. This request is not to you. This request is to the court. We're telling the judge, we give Connie 3 chances to pay. 30-day notice, 60-day notice, and then we give her a warning that we're going to start this action. In fact, during this whole period of time, a foreclosure period, right? Connie had an opportunity to fix the problem, plus late fees, attorney fees, court fees, and whatever fees, right? But there was an opportunity. So, Your Honor, what we're demanding is that the property be sold and any money that comes from it be recovered. Does that make sense? All right. So that's why when they do a summons and complaint or they start litigation against you, they don't start for like, hey, Connie owes us 3 months, $6,000. No. Connie owes $240,000. She's been late for 3 months, but she owes the full amount. Does that make sense, guys?
And then Connie loses her house, and that's the end of the consequence.
No, there's more. We're gonna go over that. Well, Shanice, I think I addressed what would happen. Yeah. All right. So other parts of the mortgage or deeds of trust allow the lender to take care of the property. And if the borrower's negligence on the property condition or default or liens or even require property insurance. Now, if the borrower doesn't maintain the property in good condition or doesn't keep up the property charges, the lender may do so to protect the security against potential physical or monetary losses. So this is called forced insurance, for instance. Once they do a forced placement insurance, like let's say you didn't pay your insurance, it was like $1,000 a year. The lender, to protect their interests, they're going to get whatever policy. So now it's $4,000 a year. And guess what? You are responsible for paying it. We went from 1,000 to 4,000. What they saying? Yeah. We went from $1,000 a year to $4,000. And you're like, well, I could have paid that myself. It would be cheaper if I had but you didn't. You see what I'm saying? So it's called forced place insurance. Taxes. They can take over the taxes. And once they do, because it's a financial claim, they can foreclose on you for doing that. They can, if it's damage on the property, they can go and fix it, and then they bill you for the full amount. So you're like, well, I could have painted the house, as an example, stupid example. I could have painted the house for $5,000, the whole house. Why is the bank charging me 12? Because that's how much they paid. They didn't go and choose the cheapest painter. They went and choose the union worker. Yeah, so you're getting paid a lot of money. You have to pay a lot of money. Does that make sense, guys? So they can take over. Like, if you don't do it, I'm going to do it. That's what it is. And you're still responsible for it.
Who's this they, the bank?
Sorry.
Hmm.
The lender. You good?
Yeah, was that weird? Sorry.
Did everybody understand that when I said they can do it, I meant the lender? Lenders, they, the lenders? All right, because Masha just went like, who's they? Who dares to pay stuff on my behalf? Who dares to paint my house when I never asked for it? Anyway,
Do they give you a warning? Do they just show up at your house with some painter?
no, they give you, look right here. So that's what we said. They usually give you a grace period for you to fix the problem yourself. If you don't, then they'll take over. They show up with a painter.
I'm here.
Anyway. You guys good? All right. Quick reminder, if there's anything the guys feel that's complicated here, my goal with this book is to simplify as much as possible. So if there's anything that's complicated, sometimes it's terms, I cannot go around the terms because you need them. Terminology meaning, not term like term before, terminology. But if there's anything that I can make simpler, please let me know, all right? Now, transfer of the property or beneficial interest in the borrower. We did talk about assignments, right? Assignment, subleasing when it comes to leases, right? But you can transfer the property to somebody else, the whole thing. You can transfer the loan to somebody else if the provisions allow, right? So if the borrower sells or transfers the interest in the property without lender's approval, that's the key right here. It's the same thing as you assigning a lease without the landlord's permission. Remember that? Okay, so it's the same thing. If you transfer the property without the lender's approval, the lender may demand immediate and full repayment of the loan balance. This is called alienation clause. Okay, also known as due on sale clause or call clause. So alienation clause or due on sale, what they're saying is the same thing as acceleration clause, the same thing as you didn't pay me, so now I want the full amount, right? Here is, oh, there's a new owner. Well, I need to be paid because I don't know this new person. Pay me the full balance of the loan because I don't know this person immediately. This is because you did it without the lender's approval. So, Randy, I'm going to transfer my property to you. You're the new owner of the property, but there's $300,000 that I owe Chase Bank, right? So now you purchase the property. It's called either subject to my existing mortgage or assuming the mortgage. Now, as the name says, if you assume the mortgage, right, then somebody's going to have knowledge of this, right? The bank is going to know. But if you buy it subject to, the bank doesn't know. So Randy, here you are, something happens to the property and the bank gets notified that there's a new owner for whatever reason. The bank's going to knock on your door and say, hey, who are you? And you're like, oh, I'm the new owner of record right here, the deed, right? I'm like, I don't know you. I don't know you. That's what the bank says. I don't know you. So therefore, I'm going to start the foreclosure action. By the terms of the mortgage, remember we said that before? By the terms of the mortgage, I'm going to start foreclosure action. Okay, I'm accelerating the debt till today. So I want the full amount on the loan. So that's a risk that you go through, Randy, in this scenario. Okay, so alienation clause and due on sale clause is what happens when we close. This is where the banks say, hey, before you transfer, pay off the balance of the loan. Okay, it's due at the time of sale. The whole balance is due at the time of sale. Okay. So let's talk about assuming a mortgage and then subject to. We did talk about before assuming assigning a property, right? It's the same scenario. When you assign the property, there's liability. The assignor remains liable, but the assignee is primarily liable, right? You guys remember that? Tell me you remember. Yes? No? So I was like, no. All right. When we do that transfer of contract to somebody else, when we do a transfer contract to somebody else, we transferring not only the property, but also the duties and obligations. So if you owe me money and you're transferring their rights to somebody else, that somebody else now owes me money. But you were the original person with the obligation. So now both of you owe me money. You guys understand? So let's say when I transfer to Randy, if Randy does not pay the bill, like I left, I'm out. Here comes Chase Bank and says, Randy, you're not paying. I'm going to sue you and Bruno. You guys understand? Me as the assignor, because I was the original party, the original with the obligation, and Randy as a new person on the property, right, with a primary obligation, only because he assumed the mortgage. So assuming a mortgage, under a mortgage assumption, the buyer agrees to take over the seller's remaining mortgage payments after having paid a portion of all the equity in the property, in which is the difference between the value of a property and anything owed on it. Now, the buyer, Randy, in this scenario, becomes personally obligated for the payment of the entire outstanding debt and becomes like a co-signer on the seller's note. If the buyer now fails to make scheduled payments, he not only can lose the property and any equity on it, but he would also be liable for payment of any deficiency remaining after foreclosure. In the event of foreclosure, due to buyer's default, the buyer, so Randy in the scenario, is primary liable for the deficiency, and the seller, me in this scenario, is secondary liable in this situation. Unless, of course, it was released from the obligation through a novation. You guys remember novation? What is novation? Nova means new. So novation is a new contract where, yes, Elizabeth, where we're substituting an old contract for a new one. So unless it says, when we made the agreement, Randy, you, me, and in Bank of America, right? I mean, Chase, when we made the agreement that I was stepping out, unless we made that release, so a new contract just between the two of you, unless we did that, I'm still liable. So if you default, I default. Does that make sense? All right. So let's say you pay off the mortgage because it's on you. Now the property goes back to you. No. Guys, when we're buying subject to or assuming a mortgage, the deed is now under Randy's name. I sold it to Randy. But remember, there's different documents. There's the deed that relates to the transfer of ownership, and there's a mortgage, and there's a promissory note, right? The mortgage is against the property. The promissory note is against the person. So when we transfer these rights, the promissory note is now against Randy as well. But the title to the house, the deed, is already under his name. When he finishes paying it off, the property is his. I mean, it's already his, but the property is his. It doesn't go back to me. It doesn't go to anybody else. It's his. All right? You guys got it? Okay. The issue at hand is not title. The issue at hand is who's responsible for the debt. So what we're looking here is who is responsible for the debt. Randy is, but so am I, because he assumed my mortgage. It was my initial obligation. I transferred to him, right? So now he's responsible as well. So the bank doesn't care who they sue, they just want their money. Well, they are suing the people that were part of the contract. So they're suing both because they're part of the contract. Me originally, and then Randy is secondary. The bank doesn't care who pays them. That's a different story. As long as the money's coming in, would you care? As long as you pay, somebody's paying me, I don't care who's paying. Right? That's pretty much how it works. Like if you want to pay my electrical bill, they're not going to say, who are you? They're like, oh, give me the money. Right? That's it. And when I stop paying my electrical bill, they're not going to come after you, the person that was paying. They come after me because that's my name on it. So they don't care who pays. What they care about is who's on title and who's on the obligation. I was originally in the obligation. Randy is now in the obligation. But because it's with the lender's consent, that's what assuming a mortgage is, with the lender's consent, his name is now on the documents with the bank. Okay? That's why the bank sues Randy and me. We good? Okay. Because that's different from this one, the buying subject to. See, when I started investing in real estate, this is how I started, subject to. So I would get leases with option to buy. So I'm buying subject to existing mortgages that are there. Leases with option to buy, and I would flip the leases, the options actually. All right. So it's one form of subject to purchases. What we're saying is, we know there's a mortgage. We're not paying off the mortgage, but we're still transferring title somehow through a power that gives me equitable title. You remember that? There's legal title, there's equitable title. You guys know the difference? Legal title and equitable title? Let me know in the chat. Something like that. Let me know in the chat. What is the difference between equitable title and legal title? Type faster. Come on, we gotta go. All right. Equitable title means that once you body have equity already to use. Equitable title is financial interest in the property. Yep. Legal title is when you pay it off. Legal title is the actual ownership. Equitable title is interest in the property. So yes, to make it simple, legal title means my name is on the deed. My name is on the deed. I'm the legal owner of the property. Legal owner of the property. Equitable title means I have an interest in the property. Okay? Equitable title means I have an interest in the property. In this case, equitable interest or monetary interest. Okay? So a buyer, when they buy something, or when the process of buying something, they become equitable title owners. Okay? But they're not legal title because it still did not transfer to them. So very simple, just use what Shakira wrote, simplest way. Legal title is the actual ownership, while equitable title is an interest in the property.
If you have a mortgage, the bank has equity.
Yep. If you have a mortgage, the bank has equitable title. Technically, the government also has equitable title to the property. So there's a bunch of people that could have equitable title because they have a beneficial interest to it. Okay. So if you don't pay the taxes, what could happen? They can foreclose. If you don't pay the bank, what could happen? Foreclosure. So technically, they have equitable interest in the property, which could lead to title. Just like a buyer has equitable interest, that's going to lead to title, right? When we close. All right. So buying subject to. When you're buying subject to, we are not telling the bank that we own the property. See, I'm going to transfer it to Randy, right? Where's Randy? Okay, somebody left, so he moved up. All right, so Randy, I was just looking at where you were on the screen. So Randy, now I'm going to sell it to you, but we're not going to tell the bank. So now Randy's the new owner, legal owner. He has a legal title, but we didn't tell the bank that Randy's the one making the payments. I just left. Okay. That's called buying subject to. The buyer agrees to take over the remaining mortgage payments. Same thing as the assignment. after paying a portion or all of the equity. The buyer does not personally obligate himself. See, because we never told the bank doesn't know about Randy, and Randy doesn't care about the bank. So there's no personal obligation. There's nothing in writing that says he's obligated to pay, I'm sorry. Does that make sense so far? Yeah. The only thing that makes it illegal is the terms of the contract. Transferring title has nothing to do with the terms of the mortgage. Okay? What might be illegal is on the terms of the mortgage. If the mortgage says no assignment, no assumption, no transfer of title, whatever, that's illegal as far as the terms of the mortgage itself, but not like illegal, federal or state illegal type of thing. No. So Randy did not make himself obligated. He simply agreed to make payments on it. That's it. Oh, Bruno, yeah, I'll take over your mortgage. No problem. I'll make the payments. All right. So if he fails to pay, let's say a few months go by or a few years go by and he fails to pay, right? What happens? He loses the property and any equity on it. That's it. Can he get sued for the difference in the loan amount, whatever the balance is? Can he get sued? No, because he's not personally liable. Who gets sued? I do. The seller remains solely liable for the outstanding debt under the terms of the promissory note when financing the purchase of the property. I want you guys to remember this. Treat this, assuming the mortgage, think of it as assigning the lease. Buying subject to the mortgage, think of it as subleasing. Because you guys remember, in subleasing, my roommates are not responsible for the lease. If I cannot go and say, go to my landlord and say, hey, landlord, my roommate didn't pay, so I can't pay the rent. The landlord's gonna go like, who are your roommates? On the lease, I only see your name. So it's pretty much the same, okay? So we have, assuming a mortgage is like an assignment or transfer of rights and obligations, right? So we all acknowledged it. Randy is the new person on it, right? And everybody acknowledged, all the parties, right? Subleasing, or in this case, buying subject to, is we brought somebody else, but we didn't really tell the higher authority. So we didn't tell the landlord in the subleasing, we didn't tell the landlord, and in the buying subject to, we didn't tell the lender. If you remember assignment of a lease, the assignor has secondary liability. Assignee, because it's by agreement, the assignee is the one primarily responsible. Assuming a mortgage, the assignor, which is me, has secondary liability. The assignee, which is Randy, has primary liability, because again, it's by agreement. All the parties know about it. Buying subject to, I'm the only one responsible for it. So if he walks away, Randy loses the benefits of the property and the equity. I get sued for any difference of whatever was recovered in court and the loan amount, outstanding loan amount. All right. Milton's asking, the title's still under my, yeah. What happens in both of these, it's a transfer. Again, we're talking about the mortgage itself. In any of these, I sold the property. So the title is under Randy's name, not under my name. Whether it's assuming or buying subject to, the title is under, or the deed is under Randy's name. What we're addressing is the obligations under the mortgage. You got it? What we're addressing is the mortgage obligations. Who is obligated? In assuming a mortgage, we both are. In buying subject to, only the seller is. Thumbs up? All right, cool. All right, discharge a mortgage. This is very simple. When you pay off the loan, what must happen? Remember that mortgage means death grip, right? That means the bank has a grip on your property for 30 years or until you pay off the loan. If you pay off earlier, they need to release that grip. If you pay at the end of 30 years, they need to release that grip. That grip is called lien. So lien is recorded against the property in public records. You finish paying it off, they must discharge or release that lien. Make sense? Simple as that. Why do we put stuff into public records? Why do we record things into public records? Marketable title and to give notice. Yes, to give notice to the world. What kind of notice is it? What kind of notice is it? Connie says to make everything legal. No, it is legal. It's just to establish your position and your priority in it. Okay, and that's called constructive notice. Yeah. So guys, these transactions are legal. There's nothing illegal so far of what we're talking about. We're documenting it into public records only to give notice to the world of our position in the property. Am I the owner? Am I the seller? Am I the mortgage company? Who am I when it comes to the property? So we're putting our flag down and saying, this is who I am and I've conquered on this date, whatever. Okay, that's what it is, to provide marketable title or good title. Yes. All right, so we already covered this as far as transfer. This is a quick illustration of what happens in a mortgage. So when the money is borrowed, so at the beginning, there's only two parties to a mortgage. When the money is borrowed, mortgagor is the borrower, gives the note or the mortgage to the lender, and in exchange receives the money, the loan, right? When it's repaid, the mortgagor finishes paying off the loan, and the mortgagee discharges or satisfies the mortgage. So it has to release in public records. If it's a deed of trust, there's three parties involved: the trustor, the trustee, and the beneficiary, right? So the trustor gives the promissory notes to the beneficiary, to the lender, and gives a deed of trust or deeds the property to the trustee in exchange for the loan amount. Okay? When you finish paying it off, right? When you finish paying off the loan to the beneficiary says, hey, trustee, release the deed. And that's what they do. They give it right back to you. And they reconvey the title back to the trustor. Questions? Good, right? It's pretty much just an illustration of everything we covered. All right. We also talked about tax and insurance reserves when we did our math, right? PITI. So the bank asks for money in every single payment, right? And they put that money aside. That's called escrow funds. They put that money aside for when the bill is due. Because look, insurance is due yearly and taxes are due usually quarterly. So we don't pay every month. So what they're doing out of your monthly payment is they taking money and put it into an escrow account. Okay? Escrow account is a third-party account or impound account that holds the money. Okay, we're going to talk about it tomorrow, how RESPA limits how much money they can charge you up front. RESPA is the Real Estate Settlement Procedures Act. What about flood insurance? It's very simple. If the property is in the flood zone, right, you have to have flood insurance. It's as simple as that. So I'm going to move right through, okay? All right. We already talked about why we need to record something into public records, and that's to establish priority, right? Okay. Now, to make it simple, a mortgage or a deed on a land that has no prior mortgage is called first mortgage or first deed. Simple. Any additional funds become second mortgage or junior liens. Why is it called junior? Based on priority. The first one is superior to anything that comes after. Okay, so if I have a first mortgage, right? Let's say this is the first, and this was filed in 2001, and then there's a second mortgage in 2005, and then there's a third mortgage in 2007, and then there's a construction lien in 2011, and then whatever it is, right? So I'll address construction liens at a different time, but what we're trying to say here is that number one is superior to number two. Number two is superior to number three. Okay? Why? Because of the date of recording. You guys remember we said first in time, first in line? Like whoever gets here first is the one that has superior claim or benefits to the property. So that's why they're called second mortgages or junior liens.
Like 3 mortgages?
You can have 10 mortgages.
What does the 10th person like even get?
Well, that's the thing in the case of foreclosure. See, second loans represent greater risk to the lender because they might not recover anything at all. For this reason, they charge a higher interest rate. So they want to get paid as fast as possible. Some liens can skip the line, yes. So construction lien, for instance, but I'll address that in a different time. Now, can we change the priority of mortgage liens? No, because they were recorded one first and the other one second and so on, right? Wrong. If it's by agreement, if it's an agreement, we can change the priority. Everything is a matter of negotiation, people. If I go to you and I say, hey, Emily, I know you're in first because you got here in 2001, right? I'm just getting here now. But what I'm going to do to the property is increase the value. I'm a construction loan. Okay, Emily, your first mortgage, I get it. You know, Janice owes you $50,000 by now. But I'm a second mortgage of $80,000, but it's a construction loan. So the property value is going to go up. You will benefit and I will benefit. How will Emily benefit? Because if property value goes up, right? And let's say Connie fails to pay, right? When we go to foreclosure, there's enough money for all of us to get paid instead of the risk of not getting paid at all, right? So this is called a subordination agreement. You guys know what it means to be subordinate? That means you're below, right? But in the subordination agreement, we could switch priorities as long as it benefits both parties. That's what it is. As long as all are benefit. This is when the first lien says, I don't mind switching to second place, right? And the second lien switching to first place. It's just like switching roles. It's called a subordination agreement. Are we good? Any questions on this? Questions? Going once? Twice? All right. Different types of loans. We have straight loans, amortized loans, and we have adjustable rate loans. Hold on, let's go back. Shakira has a question. Why get a second mortgage? It just seems like more debt. It is. But again, let's say the example that I gave you was for construction. You don't have money to build, right? After several years, property value went up, right? By itself. That's traditionally what happens. But repairs are needed and you don't have the full capital to do the repairs. Let's say $20,000 to replace a roof. So what are you going to do? You're going to have to borrow more money. That's what it is. It's either that or rain. You have waterfalls in your house. Like you choose $20,000 more in debt or waterfall. You know what I'm saying?
I think it's like, what's the difference taking a second mortgage, just like a personal loan to pay that off.
Why would you take a personal loan? It's for the property, not for you.
Money-wise, so I paid more interest.
A personal loan is personal obligation. Property loan, it's a lien against the property, so I can refinance the debt later on, or I can sell it and get paid off. If it's a personal loan, sticks with me, right? And usually personal loans have higher interest rate as well. They don't come at 5% or 6%, they'll come at 20%, right? Unless you have stellar credit. So it's a matter of liability, but so if you have a business, do business credit, do business loans. Okay, do not mix your personal with the business. If you have a house, the house is its own business. Do not mix personal with business. Does that make sense? All right, so make sure you keep all these things separate. But the idea behind it is I need money. All right, Shakira, let's ask this. Now we're going to mix a little bit because we're going to have to, based on your question. And that's very helpful, actually. Let's say, and I'll give you the example. I have a person that I know that needs to fix his teeth, and the whole cost is over $13,000, but he needs to do this surgery now. Okay, he does not have the money, but he has over $300,000 in equity against $300,000 of equity against his property. So what I can do now is I can go and take a second loan from the property to pay for my health. Okay, it's going to be a lower interest rate than if I took a personal loan, right? That I might not qualify for, but the equity is there. Does that make sense, guys? So that's the beauty of real estate. If you guys read Rich Dad Poor Dad as an example, there's so many books about this, but that's one that I think it's the way it's written is so simple for you to understand. If you want to buy a car, buy a house first. You want to go on vacation, buy a house first. You want to do something extreme in your life, buy a house first. Because that house is going to generate money to pay for that debt. You know what I'm saying? So it's not like a personal loan that's against you or against your salary. Buy a house. I want to buy a car that's $500 a month. I'll buy a house that will give me the $500 a month to pay for the car. Simple. Or I'm going to buy another house piggybacking on my first house. It's called leverage. Yeah, absolutely. Lewis says not in Colombia. There's a lot of stuff in Colombia that's way cheaper. Yes, I know. Yeah. Anyway. All right, types of loans. Straight loan. A straight loan is like a interest only or term loan. As the name says, it's interest only. So at the end of the term, the balance must be paid off in the lump sum. And this is called what? When there's a lump sum payment, it's called a balloon payment, right? Why are we paying this much? Because we did not amortize. We did not amortize because we did not pay towards the principal. These are straight loans. If it's an amortized loan, which most mortgages are, each payment goes towards both the interest and a portion of the loan's principal. Most mortgage and deed trust loans are amortized loan, and the word amortize means to kill off, which is what happens during the loan term as the money gradually paid back in small amounts, killing off the balance slowly. At the end of the loan term, the total amount owed, including the principal and interest, goes down to zero. These kinds of loans are called direct reduction or self-liquidating loans. With a fully amortized loan, also called a level payment loan, the lender first applies each payment to the interest due on the loan, then to the loan's principal. So the calculations we did before, the majority of the payment goes towards interest first and then principal. Even though each payment stays the same, the loan balance gets smaller. More of it goes towards paying off the principal and less goes towards the interest. If the borrower makes extra payments that go straight to the principal, the loan will be paid off faster, and the required payment stays the same, but more of each payment goes towards paying down the principal, which shortens the length of the loan. So We already covered this. Let's go to the next one. A partially amortized loan. As the name says, if it's partially amortized, are we killing off the loan fully? No, we're partially killing the loan. So that means that at the end, what are we going to have? Let me see if you guys can go by logic. You're going to have what? A balance, and you're going to have to pay that balance, and that's called a? It's called a? No, you had it right before, or you were just reading. Thank you, Amir. It's called a balloon payment. Yes. If you're not fully amortizing and there's a balance at the end, it's always called balloon payments. See, the payments are not sufficient to liquidate the debt. So at the end of the agreed term, the borrower is required to pay off the full balance in a lump sum. This is also called a balloon mortgage because it starts with the initial period of low or no monthly payments and ends with a higher inflated payments to bring the balance to zero. Higher inflated or balloon payment, right? So instead of paying $1,500 a month like a fully amortized loan, so in the fully amortized loan, it's $1,500 throughout the lifetime of the loan. Your first payment equals your last payment. $1,500, $1,500 every single month for 360 months. Okay. A balloon payment could be $1,000 instead of $1,500, and that $500 difference is accumulating towards the end. Or the example I gave you guys before. It could be based on 30 years, but 5 years later you have to pay it off. It's still called a balloon. Okay? The fact that one of the payments is more, or the final payment is more than the monthly payments have been, that's what makes it a partially amortized or a balloon mortgage. Balloon mortgages have short-term advantage, but can be risky for homeowners and lenders alike. All right, adjustable rate mortgage. So before I go through this, I do have a video in the New Direction YouTube channel. So if you guys go to the student portal, click on YouTube channel videos and under resources, I have a video that explains this in detail. So whatever you don't understand here today, I highly recommend you go watch the video. It's like a 27-minute video, so that it's dedicated to this with 2 or 3 different examples. Okay, so adjustable rate mortgage. As the name says, it's adjustable, so it begins with one rate interest, then fluctuates up or down during the loan term, based on a specified economic indicator. Because the interest may change, the mortgagor's loan payment may change as well. The details of how and when the interest rate will change are included in the note. So, you guys ever looked at the stock market? If you ever looked at the stock market, if you see the graph of the stock market, the thing is like, it's like an EKG, right? It's so erratic, up and down, up and down, up and down, right? So imagine your payment changing like that. This month you're paying $1,000, next month you're paying $2,000. The following month you're paying $500, but then the next month after that you're paying $1,800. This is not what happens. There is, I heard this is one mortgage. Almost all the mortgages are to stay away from if they're not right for you. So I will explain that in a second. But this does not happen like that. Obviously, that would be a wrong way to lend to you. What they do is the lenders, what they do is give you a lock rate or locked for a period of time. Okay, it's called adjustment period. So during that period, 6 months, a year, 5 years, whatever, during that period, guys, stay with me and not with TVs or with other people. Stay with me over here. During that period, your rate does not change. So I know for the next 6 months, my rate is 5%. The next year, if that's the agreement of the adjustment period, my rate is 5%. For 5 years, if that's the agreement, my rate is 5%. Does that make sense? So it's a lock-in period that we go through. So at the end of that period, that's a different story. Now it adjusts to the current rates. So the details of how and when the interest rate will change is included in the note. when there is not much difference in interest rate between a fixed and adjustable rate loan, the ARM is less appealing. So usually they give you a lower rate to get you into it, so entice you. These are the common components of an ARM. We have an index, which is basically what it's based on. Okay. In this case, it's usually the United States Treasury. So whatever the Treasury note is doing, that's what this rate will do. We have an adjustment period, which I just explained. That's locking your rate for X amount of days or X amount of months or X amount of years. Okay. So it becomes kind of predictable. Okay. And then we have something called margin. Margin is what the bank gets paid, so that it's a premium above the index rate. So if the index is doing 2 right now, and there's a 2% margin, how much is your interest rate? If the index is at 2% right now, right? And the bank says, we want to get paid 2%, so that's our margin. Okay, what is your interest rate? It's 4. 2 plus 2 is 4. Now the margin does not change. The margin does not change over time. What changes is the interest. So I'm sorry, index. So if the index goes to 3, what is your new interest rate? 5. If it goes to 5, what's your new interest rate? 7. So the index is what keeps on fluctuating up and down. The 2% margin is through the lifetime of the loan. Okay. Yeah. It's just called margin. So that's what you pay. That's what you pay the bank. Okay. Now, there's also rate caps limit. Why do we have these? Well, I told you that back in the late 70s, early 80s, the interest rates were 23%. Imagine you start with a 5% interest and then 10 years later, you got 20%. That'd be crazy, right? Yeah, that'll be nuts. So what they do is they put caps to limit the increases in interest rates. Now, there's 2 types of caps. There's a periodic cap rate, and then there's a lifetime or ceiling cap rate. The periodic cap rate is in the adjustment periods. So let's say every 6 months or every year. In the adjustment periods, if the interest rate goes, like the index goes from 2 to 5, that's a really big hike. You guys probably don't think it is, but that 3% could represent $1,500 going to $3,000. You understand? I'm exaggerating, but it is a big hike. And you can tell that from what we had. We had 3% interest rates. We're now at 6% interest rates. And the house is no longer affordable, right? So to prevent that, they say that at every adjustment, this is as much as we can increase, all established by the note. Okay, it could be 1% increase, it could be 2% increase, or 3% increase max at every installment. Okay, so if the index goes to 10% and the margin is 2, what is the new interest rate? It would be 12. That would be ridiculous. So they'll put a cap rate that says 2% max increase on the rate. So if we were at 2 and the 2% max, that means that the max they can charge is 4 index plus the margin, max 6% on your new interest rate. Is that good so far? Great. Now, the lifetime of the loan rate cap or ceiling, it's pretty much saying, hey, you borrowed today, there's 30 years, right? You started at 4%. Okay. What we're saying is that over 40 years, a lot of stuff can happen, right? We saw historically lows, and then let's say if the rates keep on going up, right? Now rates are at 20%. And we're like on year 20, right? These are 20%, year 20, this would be like say 10%, whatever. That's still a ridiculously high rate compared to where you started. The lifetime ceiling says that doesn't matter what happened to the market, your interest rate will never go above this, even if they keep on increasing. Because remember, at every adjustment period, there's an increase of 2%, let's say, every adjustment period. If it keeps on going like that, then once we get here, we're at 12%, and then 14%, and then 16%, and it just keeps on going up. With the bank saying with a lifetime ceiling, okay, is that I don't care what it does 20 years from now, we'll never charge you more than 10% in this scenario. We'll never charge you more than 10% rate, even if the rates are at 20 or 30 or whatever, I don't care. We'll never charge you more than 10%. Is that good? Yeah. All right. So the mortgagor can be protected from unaffordable individual payments by a payment cap, and the payment cap says the maximum amount for payments. But the difference between the payment made and the full payment amount will be added to the remaining mortgage balance, thus increasing the loan. So here's what we got. You see the ceiling right here? Do you see this gap? Can you guys see the yellow stuff here? All right. This gap is the lender losing money because interest rates are really high. That means they're losing money. This gap, whatever this represents, let's say over here is $10,000 this year, over here is $30,000 a year, whatever it is. This gap is added to the principal amount you owe. This is now called negative amortization. See, amortization is killing off slowly, right? Negative amortization is you're resurrecting the debt. So instead of killing it, you're resurrecting it. It's like you owe more than what you borrowed. It's not good.
Why would anyone take this loan?
Great question. Why would anyone take this loan? Because this loan starts usually with a really low interest rate compared to a fixed rate loan. Okay? Anything other, guys, anything other than fixed rates, okay? Anything other than fixed rates should be considered for short term. Interest only or adjustable rate mortgages should be short term. Balloon payments should be short term loans, meaning I'm buying the house, but I'm getting rid of it in a year or two. If it's a long-term purchase, then go for fixed rates. Okay. All right. We already talked about this. Reverse mortgage, guys. Just give me a few more minutes, please. Okay. Reverse mortgage. Reverse mortgage is where you get paid for your house. Every month, you get paid for your house. Isn't that a good thing? Get paid by who? By the lender. The lender pays you versus you paying the lender. Now, the thing is, this is only available for people who are 62 or older, and they're borrowing against their equity. The borrower decides whether to receive the funds in a lump sum, fixed monthly payments, an open line of credit, or another option. The borrower pays a fixed rate on amounts paid out by the lender, but the lender isn't repaid until the property is sold, the borrower defaults, moves, or dies. So pretty much the lender's giving you money, right, every month, and you only pay it back when you either sell the property, move out, or die. So it's a great program for people, just like everything else, for people that understand it. It's a great program for people that understand it. See, what happens here as a homeowner, I'm giving up the equity. If I'm giving up the equity, can I transfer this property to my kids? No. The bank needs to get paid. It needs to be juiced out. So when I leave, obviously there's a sale, pays off the bank, everybody's good. But when I die, equity needs to be paid. This is also called an annuity mortgage. Okay, so it's like investing. Instead of putting money into an annuity, we're putting the equity into an annuity. And it pays until I die. So if I live until I'm 120, they keep on paying. Okay, It's called an annuity.
But then once you die,
They take the property. It doesn't go to the heirs. All right, guys, foreclosure, you already know what it is, right? What you don't know, right here in the next page, is the purchaser on a foreclosure of a debt secured by real property could be the mortgagee, and the property becomes part of the lender's REO. When you see this right here, REO, or real estate owns, REO, REO, that means that the lender becomes responsible for maintaining the property and paying the expenses of ownership, including property taxes. So pretty much what happened is I wasn't able to sell at auction, so I keep the property. So it comes back to me, the lender. You lost the property, nobody bid high enough, I kept it. Now, lenders are not in the business of managing property. So what do they try to do? Get rid of it always. Okay. At one point, either during the auction or after, when it's REO, the lender gets rid of that property. Okay. All right. Methods of foreclosure. We have judicial foreclosure, non-judicial foreclosure. We have strict foreclosure. Judicial foreclosure, obviously, is what we have here in the state of New Jersey. That means we go through court proceeding. Judicial foreclosure is a court proceeding, as the name says, judicial. Right? So we go through court. I already explained the whole process, so I'm just going to move straight to the key points. One of them is a lis pendens. A lis pendens, or lawsuit pending, we already covered this name before as well, right? Litigation pending. Gives public notice that the property may have a judgment against it very soon. That may even affect the ownership. The next term is writ of execution. As the name says, execution is for somebody to do something, to execute something. Writ means ordered. So order of execution is when the court says, hey, sheriff, sell the property at auction, and any money that comes from it, give it to the plaintiff, which is the lender. Okay. So the writ of execution is telling them to go ahead with a public sale and the sale, what to do with the sales proceeds. The next term is deficiency judgment. So deficiency judgment can be requested to the court by a mortgagee, and if the sale does not yield sufficient funds to cover the amounts owed. So pretty much, we sold the property for $300,000, but you owed me $500,000. Can I sue you for $200,000? The answer is yes. Okay. This actually enables the lender to attach and foreclose a judgment lien on other real property or personal property that the borrower owns. Okay. Right of redemption. Okay, so even before, even after the sale happens, you have the right to recover your property. Did you guys know that? Auction is today. In Jersey, as an example, you got 10 days to come to the sheriff's department with a check for the full balance of the loan, for any late fees that were attached during the trial, and attorney fees, court costs, and whatever. So you got to come up with a full balance and pay it off. But you got 10 days to do so. It's called right of redemption. In some states, you have up to 1 year, like Florida. You have up to 1 year to get your property back. Yep. Non-judicial foreclosure. Can you guys take a wild guess? If judicial is through court, what is non-judicial? Out of court. So this is like an expedited foreclosure. I'm going to write here, expedited. It's fast because we don't go through court. If we don't go through court, we go straight to auction. So in the judicial foreclosure, non-judicial foreclosure can force the sale of the property without a foreclosure suit. The power of sale clause in effect enables the mortgagee to order a public sale without a court decree or order. The foreclosure process starts on the default when the foreclosing mortgagee records and delivers notice to the borrower and other lien holders. After the proper period, could be 90 days, could be 180 days, depending on the state that you're in, 90 to 180 days. A notice of sale is published, the sale is conducted, and all liens are extinguished. The higher bidder then receives the unencumbered title to the property. So, because we didn't go through court, we went straight, we bypassed the whole thing, we went straight to auction. That's pretty much what happened. It's called a trustee sale instead of a sheriff sale, right? Because we went straight to auction. The lender does not have the rights to a deficiency suit or judgment. The lender has to sue separately. Okay? What's happening there, Emily? Jumping in and out. All right. So the lender instead must file a new deficiency suit against the borrower. As far as reinstatement and redemption, during the notice of default and notice of sale periods, the borrower may pay the lender and terminate the proceedings. The exact reinstatement periods vary from state to state, and there is no redemption right in a non-judicial foreclosure. So that means once the auction is done, it's done. Judicial states, not only it's a lengthy process, they still give you an opportunity to recover the property. Non-judicial states, that's why I said expedited, it's literally, hey, we sold, there's no turning back. Until the sale, you had options. Now it's done. Okay. Strict foreclosure. Just 5 more minutes, guys. This is the last thing. Strict foreclosure is a court proceeding that gives the title to the lender directly by court order instead of giving cash. So we're not doing an auction. A strict foreclosure is, here's the deed, bank, take it. So we're not selling to anybody, not to a third party. In a judicial foreclosure and in a non-judicial foreclosure, we're selling the property to a third party if possible. If they don't sell for enough, the bank keeps it, but they have to go through these processes. If it's a strict foreclosure, the judge just says, here, bank, the title is yours. Simple as that. And then the lender can sell it regular transaction later time. All right, 2 more terms. We have deed in lieu and we have short sale. A deed in lieu says here, a defaulting borrower who faces foreclosure may avoid court actions and costs by voluntarily deeding the property to the mortgage. This is accomplished with a deed in lieu or instead. In lieu means instead of foreclosure. Again, I have no idea why they don't just translate this to simple terms. Deed instead of foreclosure. It's an exchange. So this is voluntary. If you're going to the bank and say, hey, listen, I can't afford it. I realize it. Bank, Chase, could you please accept the deed instead of foreclosing against me? There's great advantages to this, right? One of the advantages for us is it doesn't affect our credit as much because it's not a foreclosure. Okay, it's a satisfaction or a settlement in our credit report, not a foreclosure. For the lender, they're not spending money in court, but it does not terminate. This is the challenge. It does not terminate any existing liens on the property. See, in a foreclosure, once the auction is done, if there was not enough money for a second and third and fourth mortgage to claim, then they lost their money. If it's a deed in lieu, they're still attached to the property. So then the lender becomes the owner and has to negotiate with them individually. Okay? But a deed in lieu is like giving up the property.
But then you also give up like money.
It's going to be a negotiation between everybody. They still can come after you for deficiency judgments, the other ones. Yeah. All right, and the last one. You guys ready? So I can send you on your, resting period until tomorrow. Short sale. All right, I think I had mentioned already before, there's nothing short about a short sale, right? It's a very lengthy process. But a short sale in real estate is an offer of a property at an asking price that is less than the amount due on the current owner's mortgage. A short sale is usually a sign of financial distress homeowner who needs to sell the property before the lender seizes it in foreclosure. The process must be approved by the lender, and all of the proceeds of a short sale go to the lender. This is very important. In the short sale, all the proceeds go to the lender. So it's still you, the homeowner, selling the property. But because you're selling for less than what you owe, you cannot make any money. Okay? This is a crime. And a lot of people were doing this. A lot of people were negotiating to still walk away with money in the short sale. That is illegal. If you receive any money at the time of a short sale, that money needs to go to the lender. Okay? Now, the lender has two options, either to forgive the remaining balance or to pursue a deficiency judgment that requires the former homeowner to pay the lender all or part of the difference. In some states, this difference in price must be forgiven. So can they come after you if you accept a short sale? No, because a short sale in the eyes of some of the states, in the short sale is a settlement. So if the lender agrees to allow you to sell for less, they also agree to waive the difference. It's a settlement. Does that make sense, guys?